My copy of his new book, Mastering the Market Cycle, Getting the Odds on Your Side, is already dog-eared.
And he wrote a letter, and somehow or other I got into war. And that changed my life.
Something feels off in the market right now, but it is not obvious at first glance. Prices are rising, headlines are calm, and investors seem comfortable. Yet beneath that surface, a subtle but powerful signal is forming. A signal that one of the most respected investors in the world has warned about. Howard Marks believes the market is flashing a dangerous message, and if history is any guide, ignoring it could be costly. This is not fear for the sake of attention. This is coming from someone who built a career by understanding cycles, risk, and human behavior better than most. Howard Marks is known for one thing above all else: recognizing when investors become too comfortable. Because in financial markets, comfort is often the biggest warning sign. Let us start with a simple idea that drives everything he talks about. Markets move in cycles. Not straight lines. Not permanent trends. Cycles. Periods of optimism followed by pessimism. Risk-taking followed by caution. Booms followed by corrections. Right now, the signal he is pointing to is not loud, but it is clear if you know where to look. Investors are once again reaching for risk. Money is flowing into assets without deep concern for valuation. There is a growing belief that the system will continue to support prices, no matter what happens. That belief is where the danger begins. Think about what has happened over the past decade. After the global financial crisis, central banks injected massive liquidity into the system. Interest rates were pushed to extremely low levels. This made borrowing cheap and encouraged investment. It also pushed investors toward riskier assets in search of returns. Stocks rose. Real estate surged. Even speculative assets saw explosive growth, and for a long time it worked. But here is the problem. When something works for too long, people start to believe it cannot fail. Howard Marks has repeatedly warned about this mindset. He calls it the illusion of safety. When investors feel safe, they take more risk. When they take more risk, prices rise further. And when prices rise, the feeling of safety increases even more. It becomes a loop. Now ask yourself this question: what happens when that loop breaks? This is where the dangerous signal becomes clearer. Risk is being underpriced. Investors are not being properly compensated for the risks they are taking. This can show up in many ways: tight credit spreads, high valuations, aggressive lending. All of these are signs that caution is fading. Pause for a moment and really think about this. If investors are accepting lower returns for higher risk, what does that tell you about the market environment? It tells you that confidence is high, too high, and excessive confidence has always been a precursor to problems. Let us dig deeper into what this looks like in real terms. In the credit markets, companies are able to borrow money at relatively favorable terms, even if their financial position is not strong. This suggests that lenders are not demanding enough compensation for the possibility of default. In equities, certain sectors are trading at valuations that assume near-perfect outcomes. Growth is priced in. Risks are ignored. Any disappointment can lead to sharp corrections. At the same time, speculative behavior is quietly returning. It may not look exactly like previous bubbles, but the patterns are familiar. Chasing trends, ignoring fundamentals, believing that this time is different. Howard Marks has seen this before, many times. One of the most important ideas he emphasizes is that risk does not come from what you know. It comes from what you do not know. And more importantly, from what you assume is safe but is not. Right now, many investors believe the system is stable. They believe central banks will step in if needed. They believe markets will recover quickly from any downturn. But what if those assumptions are wrong? This is where things get interesting. For years, central banks have played the role of stabilizers. Whenever markets faced stress, they provided support. This created a sense of security, a belief that there is always a safety net. However, the current environment is different. Inflation, even if it has cooled, remains a concern. Interest rates are higher than they were for most of the past decade. Debt levels are significantly elevated. This limits the ability of central banks to respond aggressively. And if that safety net is weaker than expected, the entire risk equation changes. Now imagine a scenario where markets begin to decline, but central banks cannot intervene as quickly or as strongly as before. Confidence could drop, selling could accelerate, and the system could face pressure from multiple directions. Here is another layer to consider. Liquidity. Liquidity is what allows markets to function smoothly. It is the ability to buy and sell assets without causing large price movements. During normal times, liquidity is abundant, but during stress, it can disappear quickly. Howard Marks has often highlighted how liquidity is not constant. It is there when you do not need it and gone when you do. This is a critical point, because many investors assume they can exit positions easily if things go wrong. But in reality, during a crisis, everyone tries to exit at the same time, and that is when liquidity vanishes. Prices drop sharply, panic spreads, and losses become amplified. Let me ask you something that most people do not consider. If the market suddenly turned against you, would you be able to react fast enough? Or would you be caught in the same wave as everyone else? This is the kind of thinking that separates successful investors from the rest. It is not about predicting the exact timing of a downturn. It is about understanding the environment and preparing accordingly. Howard Marks is not saying that a crash is guaranteed tomorrow. That is not his style. What he is saying is that the conditions for risk are building, and the market is not fully recognizing it. That is the dangerous signal. It is subtle, it is quiet, but it is there. Another important aspect of his perspective is the role of psychology. Markets are not just driven by data. They are driven by human behavior. And human behavior tends to swing between extremes. At the peak of optimism, people believe nothing can go wrong. At the peak of pessimism, they believe nothing can go right. Right now, we are not at extreme optimism, but we are moving in that direction. And that shift matters, because it changes how people make decisions. When optimism increases, standards decline. Investors become less selective. They accept weaker deals. They ignore warning signs. And they justify higher prices. This is how bubbles form, not suddenly, but gradually. And when they burst, it feels sudden. Howard Marks often talks about the importance of second-level thinking. This means going beyond the obvious. Not just asking what is happening, but asking what it means and what others are not considering. For example, if everyone believes the economy is strong, asset prices may already reflect that belief. So even if the economy performs well, there may be little upside left. But if anything goes wrong, the downside can be significant. This asymmetry is where risk hides, and this is exactly what he is warning about. The market is pricing in positive outcomes while underestimating negative possibilities. That imbalance creates vulnerability. Now let us connect this to the present moment. There are several forces shaping the global economy right now. Technological advancements are driving growth. Artificial intelligence is creating new opportunities. Governments are investing heavily in infrastructure and innovation. All of this sounds positive. But markets do not just react to what is happening. They react to expectations. If expectations become too high, even good news can disappoint. This is a concept that many investors overlook because they focus on absolute outcomes rather than relative expectations. Howard Marks understands this deeply, and that is why he pays close attention to sentiment, valuation, and risk tolerance. Right now, sentiment is leaning toward confidence. Valuations in certain areas are elevated, and risk tolerance is increasing. Individually, these may not seem alarming, but together they form a pattern that has historically preceded periods of volatility. Let me bring you into this even more. Imagine you are driving on a road that looks smooth and clear. No traffic, no obstacles. Everything feels safe. Would you speed up? Now imagine that same road has hidden cracks beneath the surface. You cannot see them, but they are there. If you keep accelerating without caution, what happens when you hit one of those cracks? That is the situation the market may be in right now. The surface looks fine, but the underlying structure may be weaker than it appears. Howard Marks is essentially saying, slow down, pay attention. Do not assume safety just because things look calm, because the biggest risks often build during the quietest times. And here is something that makes this even more important. Opportunities are created during periods of stress. When markets correct, when fear rises, when prices fall, that is when the best investments often emerge. But to take advantage of those opportunities, you need to survive the downturn. You need to avoid excessive risk during the good times. That is the balance. That is the discipline. And that is what most people struggle with. They chase returns when things are going well, and they panic when things go wrong. Howard Marks takes the opposite approach. That is how he has navigated cycles successfully. So when he says the market is sending a dangerous signal, it is not something to ignore. It is something to understand. Not with fear, but with awareness. Because the goal is not to predict the future perfectly. The goal is to position yourself in a way that can handle uncertainty. And right now, uncertainty is higher than it appears. The market may continue to rise. It may remain stable for some time, but the underlying risks are building. And when those risks eventually surface, they will test assumptions, challenge confidence, and create volatility. The signal is already there. The question is whether you are paying attention to it. Because by the time it becomes obvious, it will no longer be a signal. It will be a reality.